Howdy everyone and welcome to the channel. Today we're talking about 401k rollovers. I often hear people say that you should always roll over your 401k into an IRA after you leave your old employer. I've heard it from financial advisors, those who have achieved financial independence, and even random people on YouTube. While this can be fabulous advice, it's not right for everyone. However, there are scenarios where it makes sense, so let's start by discussing some of those. IRA rollovers can provide you with broader investment choices. Within a 401k plan, your investment options are inherently limited. My employers, for instance, have only offered between 10 and 15 funds in addition to the standard target date funds. And this can be really limiting if you have a specific asset allocation that you want to target, but there's not an index fund for, say, small caps or real estate included within your investment options. Furthermore, after you exclude funds with high expense ratios, stable value funds, and funds which have historically underperformed their particular index, you're not left with a lot to work with. If you roll over your funds to a pre-tax or a Roth IRA, you have infinitely more options. When it comes to mutual funds, for example, Fidelity offers 312 and Vanguard offers 130 as of the recording of this video. Additionally, within an IRA, you can also invest in exchange-traded funds or ETFs, as well as individual stocks, and even make some conservative options trades. IRA rollovers can also give you access to low-cost investment options. One of the biggest criticisms 401k plans receive from personal finance enthusiasts is that the investment options can be really expensive. While more companies are including low-cost index funds as investment options, many plans still mainly offer mutual funds with very high expense ratios when compared to something like the FISVX, the Vanguard S&P 500 fund, or FZROX, Fidelity's Zero Expense Total Market Index Fund. Additionally, administrative fees for the 401k plan itself can add up. The last time I looked, I'm spending $60 annually on fees from the 401k provider before I even add in the money I've lost from expense ratios. Various research studies on millennials in the workforce have found that folks change jobs on average every 2 years. If each time you leave a job, you also leave your 401k funds with your old employer's plan, it can very quickly become unmanageable. This applies to your ability to keep track of what's going on in your accounts, as much as it applies to the various 401k fees eating into your potential profits. By consolidating your funds within an IRA, you're able to choose the brokerage you're most comfortable with and enable a streamlined access for managing everything. However, there are also some compelling reasons not to roll over your 401k into an IRA. The first reason I wanted to highlight is taking a 401k loan. Tapping into your retirement accounts before you're actually retired can be a bit of a controversial topic. Obviously, I'm speaking from my own perspective because I'm not a financial advisor. That being said, if I had a personal circumstance that required me to leverage the money I had in my retirement accounts, I would choose a 401k loan over a direct withdrawal from my traditional or Roth IRA each and every time. When you take a 401k loan, you have the option to pay that money back into the account. While you may lose out on some short-term growth, you're still able to ensure your funds remain tax advantaged in the long term. The next scenario where it would probably be beneficial not to roll over your money from a 401k into an IRA is if you're retiring early. The IRS's age 55 rule allows people who leave their employers to have penalty-free access to their 401k funds up to 4.5 years early, provided certain conditions are met. However, these provisions only apply to your 401k from your most recent employer, not older 401ks, and not rolled over funds that are sitting in IRAs. I'd imagine you can get around that by rolling over the old 401ks into the current employer's plan before leaving the firm. The next scenario is if you're trying to do a backdoor Roth IRA. So a Roth IRA is a type of individual retirement account that's generally not taxed when funds are withdrawn, provided some IRS preconditions for the account are met. It's really attractive because it allows you to grow your wealth tax-free. However, not everyone is eligible to contribute to one because there is an income phase-out. Folks whose incomes exceed the Roth IRA contribution thresholds often opt to make after-tax contributions to a traditional IRA and then roll that over into a Roth IRA. This is known as a backdoor Roth IRA. However, the IRS's pro rata rule says that when a distribution is made from a traditional IRA that contains both pre-tax and after-tax dollars, the distribution will consist of a proportionate amount of each. Let's say you have $4,000 from an old 401k that you rolled into a pre-tax IRA, and you want to make a $6,000 IRA contribution this year using the backdoor Roth IRA process. If you converted $6,000 from the traditional IRA to a Roth IRA, you would owe taxes on 40% of the conversion, or $2,400. You can't get around this rule by opening a new pre-tax IRA, as the pro rata rule applies to the combined balances across all of your pre-tax IRAs. That includes traditional, SEP IRA, simple, rollover, etc. However, since this scenario involves pre-tax funds that were originally from a 401k, you may have the option of rolling those funds into the 401k with your new employer and proceeding with your Roth conversion from there. If that happens, you're able to make a conversion without incurring additional taxes. The next thing you want to think about is ERISA protection. So the Employee Retirement Income Security Act of 1974, aka ERISA, is a federal law that governs employer-sponsored retirement benefits like 401k plans and pensions. It holds your employer and your plan administrator accountable to the Department of Labor and makes sure they fulfill certain reporting, disclosure, and fiduciary standards. All of this means that they're supposed to act in your best interests. These same requirements don't necessarily apply to the company or whatever entity you decide to work with for your IRA. Beyond that, ERISA retirement plans tend to provide more protection from creditors than a regular IRA. But that's not to say your IRA funds are fully exposed. All traditional and Roth IRAs have protection from creditors during a bankruptcy under the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. Currently, a little over $1.3 million of your combined balances in those Roth and traditional IRAs are protected. Like your 401k, most SEP and simple IRAs are protected from creditors, irrespective of your balance. My understanding is that a properly executed 401k rollover to an IRA should maintain your ERISA protection. However, you should definitely check out the IRS website or talk to a CPA to make sure you're executing the rollover correctly, because that part is key. This is my take as far as the pros and cons. Let me know in the comments what you think. Will you be doing a 401k to IRA rollover? Have you previously rolled over your 401k funds from an old employer into the new employer's plan? If you're curious about more personal finance topics, check out these videos to the right, and also like and subscribe so you can see when I post new content. Thanks as always for watching.